Forex market, I mean, just explain what the market is, how it operates, its advantages and disadvantages, and what to be aware of for somebody that's coming into this and thinking, I want to start trading.
Okay. Well, in general, the Forex market is a place where individuals or companies can meet to buy or sell currencies. And it's a huge global market. It's actually the biggest market in the world. And there are lots of different reasons that an individual or company may use the Forex market. For example, a company may need to buy products abroad or invest abroad, so they have to buy that foreign currency to do that. Or it could be an individual that needs to buy a house in France, so they need to buy, if they're living in the UK, they need to buy euros. Now, these are all deliverable examples. And what's interesting about the Forex market, and I translates into other markets as well, is that a lot of the volume is actually made up from speculating. So the examples I just gave were deliverable examples where someone actually requires the currency. But that's just a fraction. The rest of it all comes from speculating. So it's where individuals or companies are trying to make money from changes in the price. They don't actually require the currency at all. They just want to make money in changes in the market.
Okay, cool. And I mean, in terms of an advantage and a disadvantage, I mean, why would, what are the things to take advantage of and to avoid?
In particular with the Forex market, it's a very liquid market. And by liquid, it means it's easily accessible. It means that there is plenty of other counterparties or traders for you to trade with. So if you want to sell or buy, there's someone that's willing to take the other side of that order. So it's sort of unlimited in terms of what you can do there, how many, how the opportunities that you have and the trading pairs that are available. Also in terms of the time of the day, it's a 24-hour market apart from the weekend. It's a 24-hour market. Unlike stocks, you may be restricted to a certain time of the day or there's no liquidity. So it's very easy to get in and out of an FX trade. So when you're trading, you can either buy a currency pair or you can sell a currency pair. And you would commonly do this via a broker, or if you are a very large investor, such as a big company or a very large private investor, you would use your bank, like an investment bank. Now, when you're buying or selling, you don't do that directly. If you're buying, for example, you don't directly meet the seller. There's someone in between that trade, the middleman, you could say. And the broker or the bank is a middleman. And they take what's called a spread. So there is a difference between the rate that you can buy at and the rate that you can sell at, and that's called the spread. And it's usually very small in the FX market. It varies across pairs depending on things like the liquidity of that pair. So you'll see that euro to US dollar is the most traded pair in the world. It accounts for a huge amount of volume in the FX market. And so the spread on euro dollar is often very, very small. You can get two pips, 2 points between the buy and the sell rate. Whereas if you look at other pairs that are traded a bit less, the spread can be a little bit larger. Doesn't necessarily mean that you should always trade euro dollar, because there are other opportunities in these other pairs. But you might have to pay a slightly larger spread.
And what about these terms like bid, ask and rollover? How do they link into this process?
So the bid and ask is just financial lingo for the sell rate and the buy rate. So really it's just a word that they use to distinguish the two different rates there. And there are lots and lots of words in the financial markets that create confusion, but actually once you understand them, they're very easy and simple to follow. So rollover. So as I mentioned before, when you're trading, when you're speculating in the market, you don't actually require the delivery of the currency. So it means that when you trade with a broker, there isn't a fixed day where where that exchange is going to go ahead. So instead of actually going ahead with the exchange, every day that you leave your position open, the broker will automatically renew the contract to the next day. You may even not know that it's happening sometimes because you see your position in the platform and you've left it open, and the next day the position is still there. But what is actually happening in the background is that it's getting moved, the contract is getting moved by one day to the next day so that it doesn't actually go ahead with the exchange, and the currency is, you have to pay an amount of currency and another amount is delivered to you. So this process where the broker or the bank automatically moves your contract for every day that you have it open is called a rollover, a rolling contract. So when you're trading currencies, you commonly trade on what's called a leverage. So with a small amount of your own money, you have the ability to trade a much larger size. So for example, if you wanted to trade a deal size of 100,000, so say 100,000 euro versus US dollar, then you could just put down $1,000 to trade that 100,000. And that's what we call leverage. That's an example of 1 to 100 leverage, 1,000 to trade 100,000. And the advantage of this is that it gives the trader the ability to make more money with the money that they have. But there is also the disadvantage, because what you get with this leverage, with this increase in profit possibility, is also an increase in risk. So traders have to ensure that they understand the risk involved. What's very important is to understand for each points movement in the market, in the trade that you're in, how much are you risking or making for each points, and then from that you can calculate your maximum risk.
So what exactly are we trying to do here? Are you really buying or selling in the currency market?
When you're trading, you are really buying or selling in the currency market. Just because it's not a physical transaction, a deliverable transaction, doesn't mean that it's not a real trade. It's still a real transaction. It's just something that has evolved over time, which allows traders to speculate and not actually own the currency necessarily that they're trading. But it allows you to benefit from the move. And as I described with the rollovers, there's things going on in the background that allows this to happen. The contract never actually has to come to a point where it needs to be exchanged. The broker is rolling it for you every day. So the only point at which that trade is closed is when you close it.